righty, Real Fridays on July 26, 2024. Real Fridays with Rick Roque and Brock Cassidy. And is Jeremy going to join us today, Jeremy Potter?
You never know. You never know.
You never know.
I think so.
No, he's definitely ones that he always keeps us a bit wondering so what his ETA is going to be each and every Friday. But no, this is going to be really good. We have a good show for today, and of course, good conversation pieces that are going to lead into our special guest Mark Calabria next Friday, the former chief economist for Vice President Pence and the former head of the FHFA under President Trump. So, his role could be pretty substantial, right? Coming up, or it could be nothing, if President Trump wins the election, he certainly could be a candidate to be a pretty significant influence on housing policy. And of course, if Vice President Harris wins, then I can't imagine he's going to be in the top 10. Yeah. I don't even think in the top 20 of options or considerations. So it'll be interesting. I love engaging with thought leaders that are everyday people. They're people that they own a home, they go home every night, they have families, and but they wrestle with a lot of the same issues that we wrestle with every single day, but they have positions of influence to actually implement and roll out policies and regulations that could either hinder or help the ability for consumers to qualify for a mortgage. So engaging with people like Mark and other key leaders in the industry are having that kind of collaboration is vital.
Yeah, it's cool that he's made himself approachable to industry participants like the listeners on the show and of course ourselves. Yeah, looking forward to that one. Big change of pace from our usual programming in a good way.
What's hard is that when there's lack of communication, whether it's from the CFPB or lack of cooperation from any regulatory agency, state or federal, it leaves too much noise in the market. So to where the noise can be much louder than the actual guidance that these agencies could be providing,
For sure.
And so there's a lot of speculation, right? As far as, Greg Sherrod talked about, when he had interviewed Mark a couple years ago, year and a half ago, he had point blank asked, Dr. Calabria, hey, do you have something against IMBs? Are you anti-IMB? Do you really not like this channel of business? Like what are your true feelings about this channel of the business? And because so much of the policy, especially in 2020 and 2021, there was an extra tax or a fee that Mark had put onto every loan that you sold to Fannie, Freddie, and Ginnie. And it amounted to, I want to say it was 4 basis points or maybe 7 basis points, but it wasn't much, right? Especially during an era of tremendous margin gains that IMBs were assuming or were benefiting from. And I sent him a private note saying, dude, I agree with what you're doing. Like IMBs are making the most money we've ever made, in the history, well, no, without a doubt, in the history of mortgage origination. And you have, and all what he was trying to do was really just amidst a lot of complex endpoints, but was just trying to shore up in a market of tremendous uncertainty the balance sheets of the GSEs. Really not knowing what was the future, what was going to happen here in the future of the pandemic, but the industry was just so angry at this tax, if you will. So I sent him a note, and that's how I built a communication line with him. I just said, hey, man, I'm a mortgage banker. I've been in this business a long time. I see what you're doing. It makes a lot of sense to me, even though it creates a little bit of pain on the IMB side, but it's a smart thing to do. And I support you amidst a plethora of voices that yielded all kind of criticisms toward him. So,
yeah,
so to me, having him here next week is going to be an opportunity for him to dispel those, any kind of rumors or any kind of, misperceptions,
Yeah. I think in general, the IMB, but whether it's the general public, whether it's the political participants, whether it's anyone else, not saying Mark's a member of this group by any means, but I think the IMB channel is pretty easy to misunderstand. It's pretty easy. People expect depository banks, maybe credit unions as well, if we're counting them separately, to be doing a lot more mortgage than they are, in the kind of general conversation in the world outside the industry. So I think it's great that we can educate more people on what IMBs do and why they're a critical part of the home buying and home ownership, life cycle.
Now, do you see for NewZip, do you see a greater opportunity? I mean, this is a fair question, and in some degree it's not. Because IMBs make up 69% of all originations or so in the last market survey.
Yeah.
So of course IMBs are really, is that a cat?
That is a cat going crazy.
Like, is the cat in heat? Like, what's happening?
She didn't get the note on being quiet during live podcasts.
Did you step on its tail? Like, what? Did you feed the cat?
No, the cat. My girlfriend came in and the cat's chasing after her.
Oh, we could go so many directions with that, but that's great. Well,
we can bring the cat on next time.
Well, yeah. Well, what's your cat's name, Brock? You didn't strike me. I got a burly man named Brock from Maine. It doesn't strike me to be a cat guy.
Yeah. The cat came with the girlfriend, but we've become good friends.
That's how. So, should you guys get married? Is this going to be a dog household, a cat household? It's going to be a mixed.
Definitely some dogs, but this is a good cat.
Some dogs. So you're not living in the city.
We'll
you'll have to negotiate.
Always grew up with 1 to 2 dogs. Would like to do that.
Now she's in med school, right? Or is she doing her practicum?
She's in residency, so she's doing surgery.
Oh, there we go. Well,
yeah.
Well.
Good sidetrack for the show.
We just have to make sure that we don't have PETA like protesting the show, because this is, to make sure.
No one stepped on the cat this time.
I'm glad to hear the cat has been silenced in the background. However, to give it some catnip.
So the IMB audience.
NewZip's like, is it? Who benefits the most from NewZip's like offering? Would you say that, like, because it seems like depositories could potentially benefit a great deal because they might be at greater risk of losing the transaction or losing the deal between a loan officer and a realtor. And so to some degree to say, like, look, in a really super competitive environment, broker or depository, here's an opportunity where you can ensure that you don't lose that lead.
Yep. There's a few different answers to that, but the primary answer is we really built this business originally for the IMB audience, especially for the IMB audience that has any degree of direct consumer marketing or lead buying. So it's kind of, and I'm not a founder. I'm the chief revenue officer. I joined about 1.5 years ago. But the founders were basing, and part of the reason they recruited me was my background with Rocket Homes, who built a fairly similar model to help Rocket Mortgage close more business. They were losing deals to agent steering in every local market in the country when local agents had relationships with local lenders, right? So that's kind of the original impetus for this model. Was there's hundreds, thousands of other lending institutions that don't have their own real estate referral network, don't have their own real estate brokerage in-house, don't have all the real estate relationships they need. Maybe they have some of them. And so that's kind of where we started. However, we have, as a loyalty play, because we help clients save money on both buying and selling their home, and integrate so nicely into the lending transaction, that we've gotten a really strong pickup in the credit union community, and a little bit and we're starting to a little bit more in the regional banking, like regional depository bank type community. But for them, it's a little bit different. They're a little bit less worried about agent steering, and they're a little bit more worried about just true client loyalty. So they view it as one of many perks that they can give to their members, or one of many things they can give to their depository base. So honestly, like, that's not what we created the model for. So we've made a handful of changes to how the model works, and how the marketing works, and how the positioning works, to make it work for the credit union space and for the local banking space, so regional banking space, I should say. So yeah, all of the above. It's definitely, we've published our case studies on HousingWire, with some IMBs that are doing lead buying, and that's kind of still our strongest, the ROI that we blow out of the water and make it a super obvious choice. But as one of the things on the menu at a local depository, we found a good amount of pickup as well. We have about 10 credit union partners, few banks. So it's almost half and half between depositories and IMBs now.
There's how would you use predictive analytics or sort of AI tech with your platform? Like how, I noticed that not Keller Williams. What's the other? There was another large national real estate footprint that bought a I don't know if it was a CRM company or
Realogy,
but some
anywhere probably.
No, it was I'll ask you this question and then I'll look it up as you speak. But basically, they had a 60%. They had this AI tool, and whether that's true AI or what have you, but they had this predictive analytics that boasts a confidence interval of about 60% to be able to predict if a consumer is going to either put their home up for sale or is going to put themselves in a position where they themselves are going to buy, right? Mm-hmm. And so this large scale brokerage firm bought this company, obviously for a way of sort of getting ahead of the curve. And it made me think of you guys in a way where, step one is building the bridge between realtor, consumer, and loan officer. But step two could be in a way to monitor the consumer, to illuminate or advise the realtor and the loan officer as to the intent, the kind of predictive intent of the consumer. Have you guys thought about doing anything like that, or is it something that that is just out of the scope of what you guys are doing?
No, that's a big part of what we've been working on for the past, I would say, 9 to 12 months. So last December, we won Lending Tree's Innovation Award at their summit, which is basically the whole IMB audience that buys from Lending Tree, maybe a few banks. And so what we pitched there was really kind of it's not a new product. It's a new set of features that helps our core product. And it's a lot of what you're talking about right now. It's not everything. We're still expanding on it. But what we built was really, we call it Consumer Hub, where if you think about like what FinLocker does on the mortgage side of the transaction, readiness, updates, calculators, what's going on. This is kind of the synonymous real estate experience that we've built. So it's not so we can do full on home search for those that want it. That's kind of an upsell. But the core experience is just mining what consumers are looking for and giving them updates by email and by text of what's going on in their market, if they're ready to transact. It starts to talk to them about what first steps they should take, and it's all co-branded to the lender who we're marketing on behalf of. So we have, from the very up funnel, even before the client's ready to transact, we're doing marketing to them, we're doing nurturing campaigns to them, and we're showing them objective changes to their real estate market, listings that might be a fit, all that good stuff. So we mine all that activity to start to score the client on their likelihood of transacting and their likely timeline. And so we call it, we have a stat we call the home trajectory score, how quickly we think they're going to be able to buy, basically, and how quickly we think they're going to want to buy. So that's the up funnel part. But once our team starts working with a client and actually, speaking to them on the phone or by email, getting them ready to get matched with a real estate agent, looking at listings, all that, we have milestones all throughout the transaction, and we know the client's likelihood to close based on obviously the status they're in. Anyone can do that, but also based on mining all the activity we get from the lender CRM, from the real estate agent that's giving updates, and from our team speaking with the client. So any given client at any given moment, we can tell the lender their likelihood to close on the real estate transaction and their likelihood to close with the lender. We call that attachment rate if it closes with us and the lender. And we attach about 80% of the time, which is industry best. If it closes with us, it sticks with the lender we're partnered with. So yeah. That's how we think about it. So yeah, we actually have for all throughout the life of a transaction, there's a score of how likely they're going to close with us and how likely they're going to close with the lender. And when it hits certain thresholds, we flag it for the lender and say, oh, this client, has not been as active as we expected. Maybe you should reach back out. This client mentioned another lender to their real estate agent that they were thinking about talking to. You should probably get ahead of that. Those kind of things. Obviously, we can't fully cross the line into getting involved in the lending conversation. So we just flag it for the lender and kind of allow them to jump in at the opportune times to try to save deals.
Yeah, it's interesting. It was Remax. Remax bought a company called First.
Oh, yeah.
First app out of Durham, North Carolina, and First.io, I think it is. And they and it was their predictive analytics, but that was a little while ago, actually, come to think of it.
Yeah, Remax has a couple interesting plays that are not necessarily competitive with us, but they're trying to be ahead of the curve, I think, on some of these industry changes where clients are going to lenders first and things like that.
That's interesting. I mean, almost the opportunity to educate the consumer, because we go about our days and we don't really understand. We're so limited by our own understanding or our own awareness around our particular circumstance. We may not know our credit score. We may not know the value of the home. We may not know the strength of the market. But there's all these factors that are constantly being updated around us that we're just not plugged into.
Exactly.
Especially when it comes to qualifying or being able to exercise drawing equity out of a house, or there could be an investment property opportunity that you could easily qualify for that you immediately dismiss because you just don't know,
Absolutely.
And so being able to educate the consumer in a way. I was talking to Brian View about that, with his platform, and it's just, it's almost like you want something to constantly monitor the consumer based on consumer consent, monitor the consumer circumstance, and to always be providing the consumer with data and actionable data, right? And the question is exactly how do you do it, and in what areas with the consumer's consent that that's the most useful, and being able to balance out debt with equity that could be accrued with property that you own, or in the car that you drive, and be able to upgrade, swap, or downgrade or offload expenses. Being able to do that in a really useful way, because we live in such a noisy environment, right, where we're constantly inundated with data, and we don't really know how to put that in some useful approach to improve our lives.
Yeah, that's a huge part of our lender pitch, is that number one, we'll do a ton of that activity mining for you, to let you know when is the right time to kind of get in touch with the client. But even a step further, we have staffed up our kind of concierge type role. We call them home advisors, who are licensed real estate agents that are full-time NewsZip salaried employees, that their job is to follow all this activity mining, all this flagging, and reach out at the right times to get the client ready, and then to get the client back to the lender if it's the right time. So that's the playbook we're trying to develop. Admittedly, it's a little bit newer than just the agent steering prevention playbook that we do for consumer direct. But everyone in the industry has record numbers, or at least record in the last 10 years, levels of clients that are on hold or approved but haven't bought yet, or whatever you call them in your CRM, right? So we're making various features related to here based on lender feedback. The lenders we work with are what can we do for all these clients that I approved 6 months ago and now I don't know what they're doing.
Yeah. What how are you seeing the market? So when obviously business picks up and it becomes more competitive, let's say rates, they're Fannie, I think, put forward their updated forecasts around 2 expected rate corrections or rate up, adjustments to counter and to balance out some of the the improvements of the GDP on one hand, and to be able to look at some of the inflationary challenges, because appreciation is still happening, inventory constraints are still real, and things are starting to slow down a little bit with home sales as we turn the corner in the third quarter. So by dropping interest rates, it's intended to ensure that we don't bring things too far into a head or to a halt, to try to spur some economic activity. So the question is, as we drive additional volume through a rate enhanced or rate improved environment, that competitive environment is going to actually drive a greater need for solutions like yours, right?
Yeah, absolutely. We had, if you rewind a year and a half, even in our business, 2 years in our business, it was just getting started. It was right around the time I joined. Just across a couple of direct consumer partners, we did as many as maybe 10 partners would do now, deals, right? So it's like our business has grown because we've signed up dozens of lenders. But every single lender has given us a lot less business in the past few months than they would have a year ago, even 2 years ago, definitely, because so much lead buy particularly has come down, and then so much in general activity has come down. The counter argument to that, though, is that no one's been focused on refi hardly at all, and so it's been on everyone's mind to get better at purchase. Even though it's like, while times have been slow for use of our business, maybe a lot of people had getting better at purchase, at the top of their priority list the past year or so. So I think that's part of why we've been able to grab so much market share and sign up so many partners, is because so many people, there's no refi to even think about or talk about hardly. I know there's a little bit of cash out refi for like debt pay down and things like that, but everyone was trying to get a little bit better at purchase this past couple of years. And that's actually been kind of good for our business from the B2B sense, from a market share standpoint. But every given lender is just doing a lot less purchase than they could, than they will in a more friendly rate environment that we're hopefully heading to. So I feel pretty good about the course of events for our business.
No, I think that's really strong. From the retail IMB standpoint, I think it's encouraging. I mean, look, those of us on the strategic side, we tend to build into our capital market strategy, anywhere from 4 to 5 months in advance. If there's an anticipation of rate increases, you tend to build that in advance to be able to adjust to the market. So when it happens, it really doesn't. It's not. You minimize sort of the mortgage systemic risk or shock associated to a radical increase in rates. Mm-hmm. The flip side isn't true, though, right? In other words, we hang on to those higher margins as far as we can, and if there's anticipation of some reductions, we sort of wait until the competitive environment requires a reduction. So if there is a quarter point, rate reduction here in the September meeting, which it doesn't get any better than 100% chance that the Fed will cut rates 25 basis point. But we'll take it. But it's also one of those questions of what next, right?
Yeah.
How much will that actually affect, mortgage rates? Because on the mortgage lending side, we could absorb that, just to kind of strengthen our margin position going into the winter months, or we could pass a portion of that off down to the consumer. Eventually, it all comes down, because as soon as one lender and a series of lenders starts doing it, it's going to end up driving, just given the competitive nature of the environment, driving a more competitive rate offering for the consumer and for and by the lenders themselves. But the danger of cutting rates too early is that inflation could surge again, and so the impact of higher rates takes a significant amount of time. It takes a couple of years to kind of work itself out through sort of the economic landscape. The question is whether or not the Fed waited almost too long before easing up on it. I think that's been the debate over the last year, and so we've seen we've seen evidence that there's been some deterioration of the economy, and so which is what's triggering these conversations, especially around the election cycle. You have to wonder if the timeliness of a quarter point reduction here in September, just magically 2 months before an election, has anything to do with anything.
Yeah, definitely got to wonder that. So is the projection right now from Fannie or some of these other government related entities basically September and then another rate cut in November or December possibly?
Yeah, so they'll meet in September and then they'll meet again in December. To kind of close out the year.
Right.
And so I think the anticipation is that it will take place going into the first quarter.
With a total projected cut of 50 basis points between the two that are
I could check. I've seen a range of different. I don't know exactly what Fannie, but I've read from several different economists that it could be as aggressive as 80 plus basis points. It all just depends, like in its total cumulative reduction. But or it could be something nominal. I think it depends. And I don't know. I mean, the Treasury, from what I understand, is intended to be sort of agnostic to the political events. But I just don't know what. And this is probably a question more for Kevin Moreno, but questions around like consumer confidence, wages, the unemployment rolls. I think those are fairly static to. I think the average wages right now are flat to negative, like declining for the working class, and but I think unemployment has been holding pretty steady. So
yeah, I think when he came on the show, was it 3 weeks ago or 4 weeks ago? He mentioned a couple of things that I hadn't flagged for myself, which was one of them that I found interesting was that the unemployment number is pretty flat, but there's less people. But there's more people just coming out of the workforce in general that aren't like, you have to apply for X number of jobs to be counted as unemployed, so that's an interesting thing. And so much gig economy work, especially with the younger generations that are now making up a big part of the populace. Definitely an interesting time to try to make sense of all the activity, but I think it's a good time, whether that's part of the election hype cycle, whether that's a part of the normal course of economy. I think everyone can get pretty close to agreeing we probably need some rate cuts now. So it's nice.
It is pretty fascinating. I'm gonna show a chart here that I think you'll get a kick out of, or that you'll appreciate. If I can figure out how to show this. If I go to present, share my screen. Not sure which screen here. Window? Oh, here it is. Yeah. So this is a well-known, but it's a well-known curve, but it's one you really can't appreciate unless you revisit it, unless you really actually take a look at it and you see how dramatic the inflationary pressures, like where we've come from, is pretty staggering, right?
Yeah.
Year over year inflationary numbers here, and you see where we are versus where we were prior to COVID, and there's still a ways to go, right? And so the question is whether or not this was necessary, because I think so much of the economic stimulus that was poured into the economy was based on some of pushing so many people out of work, right?
Absolutely.
And the question is whether or not that was even necessary at all, or at least to the degree that it was. And that could be one question.
For as long as it was, also. Yeah.
Well, for as long, yeah. I mean, I think pretty much most of the country, for a good portion of it, I should say, opened up in that third quarter of 2020. Yeah. Whereas, the hard blue states, I think, hung on until spring of 2021. But it had created such systemic damage of so many small businesses being put out of business, and let alone just the health related crises associated to having people out of work. So the question is whether or not this was even necessary, or to the degree that it was. But it's a pretty fascinating curve, and I wouldn't mind asking Mark, what his thoughts are, on that, to see whether or not, beyond the partisan differences of COVID and masks and that kind of thing, like certainly Trump originally shut down, the economy from pretty much in the second quarter with a hope to open it up again come, I think it was May. But then I think even his own advisors were like, look, let's not be too aggressive on this,
Right. I mean, on the one hand, it'll almost be like pretty amazing, pretty shocking if we actually get some version of that soft landing scenario to work, where we come right back down to this, target inflation we were at right before. I mean, the Fed has such lagging effects that we may overshoot it either direction, of course, but well,
it's a lot easier. It's a lot easier to bring an economy to a stop, and it's a lot more difficult to get it going again.
Sure.
And so, it's I think it's damaged a lot of mortgage companies and it's put a lot of people out of work. And I think the housing sector makes up almost 20% of the U.S. GDP.
Yeah.
And so that by stalling that in the way that they have, as dramatically as they have, it's created just a tremendous amount of stress.
Yeah. In fact, Rick, another nice thing we may want to bring to next week's conversation is you showed it a lot a few months ago on our calls here, or on our podcast here, was the LO employment numbers. How many LOs are active in this market, and how much has come down. Losing tens of thousands of loan officers every month almost for the past 12 months. Every quarter, let's say that, for sure. So interested to see how that all plays out. Still a tough time to be a loan officer. Still a very tough time to be a real estate agent in most markets. But it's good to see.
What's the real estate chatter on your side? Just with the impending impending changes on the buy side.
Yeah, all some good updates. I mean, I talk about this all day, every day, as we're talking about. One of the things we do is set up our clients with commission savings, right? So it comes up a lot in our sales cycle and normal course of business to talk about these topics. But I'm going to be at the Inman Connect Real Estate Conference next week in Vegas, and there's a ton of sessions on it. So it'd be interesting to hear what everyone's saying now as we get a little bit closer to the changes that are supposed to come. I think it's August 17th. I think it got pushed a couple times, probably get pushed again. But
is that the one in Boston or in Chicago?
Inman is in Vegas. It's in New York it's the worst. It's in New York in January, and it's in Vegas in August.
Got it.
Cheap conference space, I guess. But yeah, so we usually go out there. It's like a real estate innovation conference, big real estate names, and big, like the Open Doors of the world, and big, prop tech companies. So that'll be an interesting one. I spoke there last year. This year I'm just going as an attendee. But there'll be a lot of conversation about that. So I'll report back next Friday a little bit. But yeah, I mean, from our course of business, we are expecting that commissions will come down. Buy side commissions will come down a little bit, but it'll be market by market. Some markets we definitely don't anticipate it to change. Some markets, it seems like the market's totally willing to bear that commission to get clients the top level service that the best realtors do. The trick is a lot of the newer realtors, or a lot of the just frankly worse realtors are really struggle because they're going to have a hard time justifying their value. So maybe that's a healthy part of the cycle, is to get realtors a little more focused on justifying their value. But we don't anticipate it to be like the wheels coming off the bus in the real estate world. We think it'll be, probably less change than people think, more headline bait than much else right now. But there'll be a few process changes. Buyers agreements will be signed on every deal up front. Right now it's market by market. I think it's 3/4 of markets don't sign buyer's agency agreements up front. all the time. Some markets, they do it all the time. Some markets, they do it sometimes. Most markets, they do it sometimes. So it'll be a little bit more rigorous of a process for a buyer's agent to sign a client, lock them down, take them up to show houses, justify their value. And I do think we'll see some like a la carte type models where we've heard of some people trying to talk about, just pay a certain cost for every activity. You want help with the docs, that costs something. You want help with getting showings, we'll charge you per showing. These kind of like a broader menu of options for real estate service. But I think a lot of people will still want, the best realtors at something close to what the fee structure is today. Can't hear you.
No, that's great. I think it is pretty interesting. The not just the speculation, but the anxiety kind of leading up to it. I mean, it's creating a lot of consternation. I know Michael's Keller has done some pretty good spots on that this week or the last couple of weeks.
Yeah.
From a conference standpoint, I just got back from the HousingWire AI conference, which I spoke at. I did a couple different panels on. Spoke with Dr. Andrew Moss and the professor at Stanford, and he started a company called Pointable that helps companies in their AI research and implementation. And it's pretty fascinating, man. UWM and just there will be a major differentiation between companies who implement AI versus companies who don't.
Absolutely.
I think that the neighbor's dog just ran in here. The small to mid-sized companies are just kind of what I would say is somewhat panicked, and the lack of a strategy, and how that's going to really in the end differentiate themselves. But I think on the tech vendor side, there'll be a number of solutions that are going to help level the playing field a bit. The larger enterprises will innovate and implement. I know NFM's actually, I didn't know this, but they actually created an AI sort of platform that they actually have spun off, and they're selling it to other lenders themselves. So I thought that was both pretty innovative and I don't want to say generous because they're selling it, but certainly innovative and I think their spirit is to just help, water just raising all boats, rising tides, raise all boats. But it was an amazing conference. What really, you should have been there. You actually should have been there of all people. I'll
definitely get out to. I actually was on a call with. I'm on a committee with the Mortgage Bankers Association, and Clayton from HousingWire is helping out plan some stuff. Kind of HousingWire and MBA hand in hand. So I actually spoke to him yesterday, and we're going to try to plan some stuff at the IMB Summit between some of the MBA committees and HousingWire. So I'll definitely be at the IMB Summit, maybe even helping plan a couple things related to it. So I totally hear you. Yeah, I would have liked to go to it. We were a little bit late to the game. But now the conference season starts kind of in earnest for me, or I guess the business travel season, let's say in general. Next week, Inman in Vegas. The following week, we have a board meeting out in Austin, Texas, where a lot of our team is, a lot of our investors are. And then after that, going on site with a few partners the following week. So I got business travel lined up almost every week going forward now as we start to come out of the middle of the summer into the beginning of the fall season.
Yeah, that's great. Yeah, I was asked to speak at the IMB conference in October. Which is, as you said, it's going to be in Dallas, and so I'm looking forward to that. And so I think that, and then after that, I'm not really sure. I'll probably go to the National MBA conference and probably then go to the IMB conference in January that's led by the MBA as well.
Yeah. Speaking of upcoming guests on our show. HomeBot, our newest strategic partner, they're going to be hosting a bunch of stuff out at the MBA annual conference because it's on their home turf in Denver. So they have a cool office out there. and they're going to be hosting a few different things. So we'll start posting about MBA stuff before long, and then I think we're also trying to do a live episode of Real Fridays at the New England Mortgage Bankers Conference in New Hampshire with Potter and Co. So hopefully we can figure.
Yeah, what's the what are the dates of that again?
I think it's kind of late September. Let's see.
I know I'm doing a panel.
September 14th and 13th.
13, 14?
Mid-September. Yeah.
Um,
and then I'm also going to go to the Acuma Credit Union Conference, and we'll see what else. Usually go to Lending Tree Summit, a few other things later in the fall. But yeah, the conference season's kicking off for me.
So is it only 13, 14, or is it 13 to 15?
I think
Probably
it's
just 2 days.
I think it's the Thursday and Friday. 13.
Oh, so 12 and 13.
12 and yeah. There you go. Our session's supposed to be on Friday, if all goes as planned. So that would be cool.
Good. Well, I'm looking forward to speaking at that too, and it's always good. The New England market's a great market. It's a small. I think it's about 6% of all mortgages in the country, so it's a small market segment, but it's still nonetheless, it's a really unique market segment. No doubt. So I'm looking forward to being there. So
great.
Well, good. Well, this is a wrap for Friday, for Real Fridays here, July 26th. We didn't get anything controversial or any juice other than you potentially getting us protested by PETA.
Yeah, no. Well, I saw a dog kind of going crazy on your side too, so maybe both of us. No, some big show next week. Bunch of conferences coming up. We'll keep everyone posted on those. Maybe cast from some of those, hopefully. And then, I didn't complete my thought there, but the HomeBot CEO,
that's right,
Harley, will be coming on one of the following weeks. Nailing it down with him. I think probably in 2 weeks.
Yeah, let's do that. I'm looking forward to that conversation.
Yep.
So good.
Right.
Well, we'll talk to you soon. Thank you again, man. I appreciate this episode of Real Fridays. And then Jeremy, what's up with him, man? He was a complete no-show.
Well, I like what Mike Cush had to say. We just need to hook him up with a Starlink backpack, so whatever car he's in, plane he's on, whatever, he can just give us a dial in. But we'll figure it out.
All right, we'll talk to you soon, man.
See you.